Daniel, we've heard so many different updates about the impact of coronavirus. The markets largely, at least here in the United States and perhaps elsewhere around the world, shrugging things off. Is it justified? Is this something that we can just kind of glaze over because it's a short-term phenomenon?
Well, you'd feel a little bit more confident about that view if you saw the same type of message being given by the bond markets and the oil markets, and you don't. If it really were so transitory, if there really was no medium-term impact on global growth, you would expect Treasury yields, honestly, to be back closer to 1.8 where they were before this all started. Similarly, you would think oil prices would be higher than they are today. So you do have this disconnect between the two markets. And as we get these now and again, it's up to which one you think is the right one. Equities, generally speaking, always the more optimistic. Treasury yields reflecting the more pessimistic view. So right now, we're citing a bit more, honestly, with the equity market in the medium term, but concerned that we don't really have the uncertainty that we would like to have about how soon this really is going to be ending.
You know, what's interesting over the course of the past maybe few weeks now, we've normally focused a lot more on the corporate earnings picture. Many would say that drives the markets overall in stocks, yet we are a little bit less focused, maybe relatively speaking, on corporate earnings and more focused on macro concerns. Is the earnings picture here and perhaps abroad in developed markets still supportive of stock valuations at current levels?
Well, I think the answer is yes and no. Given that we have the central banks for the most part on the sidelines, it seems, both in the U.S. and in Europe, that actually, I would argue, puts a bit more focus or should put more focus on earnings. And for the most part, things have been pretty good this quarter. You've got above average positive surprises both in the U.S. and in Europe. Given that we have modest expectations for the year for earnings growth, really under 10%, that doesn't seem so high. Companies should be able to support that. So that's really fine. The question is, what is the multiple you're putting on that earnings growth? Again, modest earnings growth, but well above average multiples, particularly in the tech sector. So the concern so much is not that earnings don't come through. They probably will. We should continue to see earnings come in above expectations. That's all fine. But is it enough to support nearly a 19 times forward earnings PE for the S&P as a whole, almost 25 times for the tech sector? I think that's a concern. So if we get another negative catalyst like we had with coronavirus, that's the risk.
All right, so I'm glad you brought up the valuations argument here. We've heard a number of folks out here on our air and elsewhere say that the market is elevated right now. And on a relative basis, it is, given previous years. But just how elevated is it, and what do you consider to be a more fair value valuation on a price-to-earnings basis, forward or otherwise, for the current market?
Well, long-run averages are about 15.5, and again, we're near 19. And you often hear this argument that, well, because of quantitative easing, low interest rates, low inflation, that'll justifies a higher multiple. The problem is, if you look at the average just over the last 10 years, really kind of our QE era, it's still about 15.5 times. So you haven't actually had, on average, a higher multiple post-global financial crisis than you necessarily had before. So when you start looking for these justifications about how it's different this time, I think that is when you start to get a little bit nervous. That said, there are two ways you can get a normalized PE. Either prices can fall, which is, of course, what we're primarily concerned about, or you can actually get decent earnings growth, but then prices really don't rise. So it kind of grows into the multiple. So that would say, at best, you should have quite modest expectations for returns for the rest of the year, with, if anything, downside risk to that outlook.